Hey guys, Grolic here of M&T Academy. Today I'm going to talk about a simple conceptual framework that I've been using for years called the where, how, when, or 1-2-3 method. It can help you take better, more objective, edge-driven trades with greater conviction while also being less emotional or prone to making irrational decisions. It is one of the bedrocks of my trading that has saved me a tremendous amount of time, anxiety, doubt, mental bandwidth, and money. It should be applicable to any manual trader, especially ones that trade with order flow edge, like with what Market Monkey Terminal provides. Let's get into it. In this video, we'll go over what the 1-2-3 method is, why it's useful, and how to utilize it yourself. One of the greatest weaknesses traders tend to have is being unable to stick to their trading plan, or even not having a trading plan at all. The 1-2-3 method aims to help traders improve their trading in a practical and straightforward way by breaking down planning, confirmation, and execution into a three-part process. The first step is the where. The where in trade planning is about identifying the locations in the market where you are interested in taking trades. These are the tools, drawings, and indicators that will align at certain price levels on the y-axis. For example, in this fixed range volume profile I've pulled that you can see, down here was a region where multiple diversified sources of edge aligned, such as the range val, the SFP level of these prior lows, buy limits, and there was even stop loss liquidity. This is called locational confluence. To learn more about confluence, check out the video I made on it in the Academy. In trading, failing to plan means planning to fail. Professional traders proactively identify their regions of interest, either mentally or with drawing tools. These regions are often called trade zones. Being prepared for pre-planned trade zones will greatly improve your ability to wait for these opportunities and to execute upon them if they confirm. It's important to understand that just because you've identified trade zones based on locational confluence, it doesn't mean that we necessarily expect to reach these areas in the market, or even that we expect to trade them. Trade zones are simply the places you are interested in taking trades if the market reaches them and how it does it, which leads us to step 2. The how is about the factors that arise if price reaches our trade zone. How did price interact in my region of interest? Was there an increase in volatility, a spike in volume, or a rise in reported liquidations? What about a change in open interest? Were the order books bullish as we approached the area? These factors are less to do with location and more about if they occurred at our trade zones. They function as confirmational factors to help us gauge if we're ready to execute the trade. If step 1 is us placing a potential target in our crosshair, step 2 is us placing our fingers on the trigger, ready to take the shot. Step 3 is the when, which is when you pull the trigger and execute the trade. Just because price might reach our step 1 and step 2 doesn't mean that there's necessarily going to be a step 3. What if price came into our trade zone, had all these exhaustive factors, but just continued selling down even though we took a long? The purpose of step 3 is the confirmation by the market of your trade idea starting to play out. In this situation, we'd want to see price starting to go up again with market buyers stepping in. There is almost zero reward for trying to be the first person onto the train. You're more likely to get flattened by it. Instead, wait for the train to pull into the station and sound the horn signaling it's about to start taking off again before you enter the trade. In this situation, as an example, if you are using local order flow such as footprints or audio flow, you will want to see and hear the market sellers running out of steam as they fail to move price down further while getting absorbed by opposing buy limits, and then see or hear the aggressive market buyers stepping in and successfully moving price up, at which point you can take the shot and set your risk. Don't be a hero. Wait for the big players to show their intentions first before you do. Most larger participants in the market are waiting for others to show their interest first, and so should you. Don't enter trades if there is no signal to execute upon them. 1, 2, 3. Step 1, the where, is helping you optimize your reward to risk ratio on trades. It's giving you regions that you're looking to enter that have asymmetric reward to risk ratios. Say this were my bearish trade region zone up here at the range VAR, and say I wanted to target a rotation to the val. This could be my major TP down here, and my risk or stop loss up above, thus giving me a positive reward to risk ratio on the trade strategy. The step 2 and eventually 3 is helping optimize the likelihood that the trade eventually goes in my favor, thus improving the win rate. It's this combination of positive reward to risk and positive win rate that combine together to give you positive expected value on a trade. The more you can optimize your reward to risk and your win rate across your trades, the more positive expected value and the more profitable you can expect to be. This is the essence of trading. Key takeaways. The where, how, when method is a simple framework for objective, high-conviction trades with less emotion. It breaks trading into 3 simple steps of plan, confirm, and execute. Step 1, the where, is planning your trade zones. Identify high-confluence price levels in advance. Then mark the zones where multiple edges align for asymmetric reward to risk. Don't have expectations about price reaching these trade zones. They're just areas of interest where you're looking to take trades. Step 2, the how, is the assessment of the interaction. When price enters the zone, check for dynamic signals, and then if it confirms institutional interest, finger on the trigger. Step 3, the when, is the execution. Enter only after the market confirms your idea. And don't be the hero. Wait for the other players to commit first before you do. There's almost no benefit to being the first in on a trade idea. The core benefits of this method is that the where will improve your reward to risk ratio, the how and the when will grant you a higher win rate. Together, these combine to create positive expectancy and consistent profitability, while also reducing your anxiety, doubt, capital loss, and preventing you from overtrading. This has been Krolok with M&T Academy. I hope you enjoyed this framework video on the 1-2-3 method. Any questions, be sure to hit us up in the Academy chat and we'll get back to you directly. Have a good New Year's. Cheers.